Hey, how's it going guys? Welcome back to another weekly market update. The crazy bull run continues. The Friday jobs report surprised everyone, and now we're almost back to the all-time high. How much further can this V-shaped bounce can go? A lot of things to cover this week, and in this video, I will first cover some extremely important updates on the US equity market, the dollar, and the bond market, and what you should be looking at next week. Also, I would like to share some of my views on the long-term outlook for the US equity market over the next 10 years, and what are the macro investment opportunities that we can take advantage of right now. This video is gonna be packed with a ton of practical values, so please make sure you watch until the end and do not miss out anything. Alright, let's get started. It was definitely another big week for the US stock market. After 3% up last week, now we just had another strong week, up almost 5%. We officially broke the 78% Fibonacci retracement level, and our next target is back to the all-time high. We can also see that on the daily chart, the volume is trending up this week too. Volatility is also going down. On the VIX daily chart, we officially broke the support level and continue heading lower. All these three components, price action, volume, and the volatility, are all showing us that the US stock market has been very bullish and very strong, at least for the short run. Apart from the major indexes, Russell 2000 is also picking up with a very strong week. In fact, the momentum of the Russell 2000 is even stronger than the S&P 500. This is exactly what we want to see in the bull market, that the small caps index outperform the big caps index with a stronger momentum. It shows the investors are more willing to take risk. Of course, one of the biggest drivers for such a strong week was the jobs report on Friday. The number just surprised everybody. In May, we added 2.5 million jobs in the economy. 2.5 million jobs may not sound that impressive. However, you gotta understand that before this May jobs report, all those economist experts were estimating that in May, we will lose another 8 million jobs and take the unemployment rate up to around 20%. But this jobs report literally shocks everyone. Instead of losing 8 million jobs, we added 2.5 million jobs. That was a 10 million job differences. Instead of going up to 20%, the unemployment rate is actually down to the 13%. It was even lower than the last month. That is huge. It definitely gives investors much more confidence, and the people start realizing that the economic recovery might be faster than we all thought. And that is why we saw a huge surge on the stock market this Friday, breaking out from the 78% level, targeting the all-time high, which I believe will get there pretty soon. Apart from the US equity market, the dollar continues its collapse after it broke down this triangle pattern. As I mentioned earlier, if you are bullish on the stock market, a weaker dollar like this is exactly what you wanted to see. Although the 2-year bond market is still trading in this tight range, we do see the 2-year yield is slowly going up and trying to test the upper bound of the range. It shows there's a small selling pressure in the bond market. If we check the 30-year yield, it just had a very strong breakout from the tight range this week. So if the 2-year yield breaks the upper bound, follows the 30-year yield, and continues going up, then we can say that we're officially back to the bull market. The bond market will be very interesting to watch for the next couple of weeks. I will definitely keep you guys updated. For the past 10 years, we have seen a consistent moving higher in the US equity market from 2009 to 2020, with a compounded annual return of 14.2%. That is a massive return. If you look back in the history, the largest gainers of those decades, whether it's crude oil, the US Nasdaq, the Japanese Nikkei, or the gold, each decade has its own dominated large macro trend that produce unbelievable returns. If we cut cryptocurrency out of the picture, for our most recent decade, from 2009 to 2020, has been best decade for the US equity, primarily the FANG stocks that has been the major drivers of the US equity market, outperforming any other macro financial assets. If we look at each one of those decades in the past, we'll find something really interesting. If one certain financial asset was the biggest gainers of the decade, then for the next 10 years, the average annual return for that particular asset class is actually negative 4.8% per year. No exception. We see that in the Japanese Nikkei during the 80s, we see that in gold during the 90s. Even for S&P, we can see this rule has been playing out perfectly. From the late 1990s to the early 2000s, that was a crazy bull run for the US stock market, especially the tech stocks. So as we can see, after a 10-year straight up bull run, for the next 10 years, from 2000 to 2010, the return for S&P 500 was actually negative 25.4%. Even though there were big up and down swings, the stock market couldn't recover for over 10 years. There's a hedge fund called Prevail Global recently did a 10-year outlook macro modeling for the $75 trillion global equity market. They combined 5 different financial models trying to map out how the equity market will perform from 2020 to 2030. The data shows, except emerging market and Japan, other major stock markets around the world will have negative annual returns over the next 10 years. They also use exactly the same model to map out the outlook for the bond market as well. They did it for both the government bonds and the corporate bonds. Same thing. Both of these two asset classes are expected to have year-over-year negative returns over the next 10 years. This is huge, not only because the bond market is a $100 trillion market, much bigger than the stock market, but also it clearly shows that over the next decade, bonds will completely lose their hedging ability to protect your portfolio. On top of that, the negative bond yield is becoming a norm in the developed countries, so bonds will not be able to generate income anymore. So what does all this mean to investors? It simply means the traditional 60-40 passive investing portfolio is dead. When the market regime shifts, investors need to learn how to adjust. Passive investing will slowly rotate back to the active investing again. And the investors who will truly make money over the next 10 years will most likely be the ones are able to forecast those growth cycles, identify the emerging macro trend, and take advantage of it in the market. Even though from point A to point B is going to be zero return, it doesn't mean the market will go flat straight line without any fluctuation. Over the next 10 years, there are going to be multiple cycles along the way. The market will go up and down in cycles that you can take advantage of. So the first adjustment the investors need to make is that instead of just passively investing in ETFs or mutual funds using dollar cost averaging, you should start more actively studying about the economic cycles and then take advantage of the short-term cycles to rebalance your portfolio more actively. The second tip I would like to give is that even though the entire index will struggle, it doesn't mean every single sector will struggle. So instead of putting everything in a broad index like S&P 500, investors should be more actively studying which sectors are doing well and which sectors are underperforming. If you know how to build a long-short portfolio, long the well-performing sectors and combine with shorting the underperforming sectors with the right position sizing, you will definitely be able to make money more effectively even though the index doesn't move that much. The third tip I would highly recommend for all the investors, especially the ones who don't really want to build a long-short portfolio, is that you can add long volatility into your portfolio as the hedge. After the Fed doubles their balance sheet in just one single year of 2020, there will be a lot of ups and downs with high volatility over the next decade. When the bonds are losing their hedging ability, long vol is a great replacement. The easiest way to implement this hedge is to use VIX ETF. In the future, I will definitely make an entire video to show you guys how exactly you can build a long-short portfolio and as well as how to use a long volatility as the hedge to protect your portfolio. Well, the last tip I would like to add on is to increase your gold position into your portfolio. I made a video a couple of days ago and I talked about why gold will have an amazing bull run over the next couple of years. Please make sure to check that video out if you haven't watched it yet. It's packed with a lot of valuable insights of both technical and fundamental analysis on gold. I'm sure it will give you a much better outlook on how gold might perform in the coming decade. When the dollar breaks the major triangle pattern and enters a rapid decline, it shows the determination that the Fed wants a lower dollar, and they will do whatever they can to keep the dollar low. Although it's a positive bullish sign for the US equity market, there are still many other mixed signals that show in different directions in the US market, and it makes the US equity may not be the best macro play for the coming decade. However, there are some other much better opportunities that we can play along with the weakening dollar. The first opportunity, and probably the easiest one to make money over the next 10 years from the weakening dollar, is the emerging markets. The countries in emerging markets are heavily exposed to the US dollar denominated debts. A weaker dollar means the debt they're currently holding becomes much more affordable. It is an extremely bullish sign for the emerging market stocks. Emerging market will benefit from a weakening dollar way much more than the US itself. On top of that, EM is way much undervalued compared with the US, so the risk-reward ratio is also much more attractive. If you want to play the equity market over the next 10 years, then you should put more focus on the emerging markets. Another one opportunity that is benefiting from the weakening dollar is the Bitcoin. I think Bitcoin is probably my highest conviction view over the next 10 years. First of all, as I mentioned earlier with the data from Prevail Global Hedge Fund, both of the stock market and the bond market will be under a lot of pressure to generate a net positive return. That means we have almost $180 trillion of assets that are potentially not going to make any money or even lose some of their values over the next 10 years. Then investors, especially institutional investors, need to find a new place as a store of value or even make some profits. Think of the entire financial market as a giant flowchart for capital. Money doesn't disappear, it flows around. When one place doesn't work, money will flow to somewhere else. This is why I've really started to become very interested in Bitcoin, which is right now a very small market. But looking forward, there's gonna be a significant amount of capital that need to find some sort of store of value. And even just a portion of those massive capital moves to Bitcoin, it will be a game changer. Yes, gold could be a store of value too, but the maximum potential return for gold might just be around 3x to 5x. Then that will lead to the second reason I believe Bitcoin will be so attractive is the risk-reward ratio. As a store of value, Bitcoin can offer much higher upside than gold. We're talking about a potential 30x or even 50x from the current price. Also, I really like how the Wall Street narrative over Bitcoin has been shifting in the recent years. We can see the trend that there are more and more sophisticated hedge fund managers and the institutional investors are betting on Bitcoin now. So, from a long-term perspective, over the next 10 years, apart from the gold, I truly believe emerging market and the Bitcoin could offer the most attractive potential risk-reward ratio compared with other asset classes. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and the business and find my videos and be valuable to you, please consider subscribing. Thanks so much for watching guys, and I will see you guys soon.